What if a new US presidency changes the market mood and you are prepared before it happens? Not with predictions, not with political opinions, but with a clear investing strategy that works in any administration. Today, Money Monkey is going to talk about how investors can think strategically during a Trump presidency in 2026, without gambling, without hype, and without turning your portfolio into a political bet. Because here is the truth. Markets react to policy, taxes, regulation, trade decisions, and economic expectations. But long-term wealth is not built by guessing elections. It is built by owning strong companies and staying invested. And yes, even a banana-loving monkey understands that. Monkey. Welcome back to Money Monkey. If you are new here, this channel is about simple, long-term investing. No Wall Street jargon. No unrealistic promises. Just clear explanations for beginners who want to build wealth step by step. Today's topic is sensitive, so let's set the tone clearly. We are not predicting politics. We are not supporting any party. We are not telling you what to think. We are talking about how investors can respond intelligently to potential economic changes during a presidency, especially if there are shifts in taxes, trade policies, government spending, or regulation. Because markets care about policy, but your portfolio should care about principles. First principle, never invest based on emotions or headlines. Elections create volatility. Volatility means prices can move up and down more than usual. That does not automatically mean something is wrong. It means uncertainty is being priced in. Many beginners make the same mistake. They hear news about tariffs, tax cuts, or regulation changes and try to buy or sell quickly. That is short-term speculation. And speculation is very different from long-term investing. Money Monkey prefers boring. Boring builds wealth. Second principle, own broad market ETFs. Instead of trying to pick winners based on political expectations, consider diversified exchange-traded funds that track large parts of the economy. For example, a broad market index fund spreads risk across hundreds or even thousands of companies. Why does this matter during any presidency? Because no single president controls the entire economy. Businesses operate globally. Markets respond to interest rates, inflation, corporate earnings, consumer spending, and global demand, not just politics. If policies favor certain sectors, some industries may perform better than others. But predicting which sector will benefit most is extremely difficult. Even professionals get it wrong. That is why diversification is powerful. Third principle, focus on long-term trends, not short-term reactions. Historically, markets have gone through many presidencies from different political parties. Some periods were stronger than others. But over long time horizons, diversified stock markets have generally grown alongside economic productivity and corporate earnings. The key word is long-term. If you invest for 10, 20, or 30 years, short political cycles become much less important. Money Monkey does not try to outguess elections. He invests consistently, reinvests dividends, and stays disciplined, even when headlines are loud, especially when headlines are loud. Fourth principle, use dollar cost averaging. This means investing a fixed amount regularly, for example every month, regardless of market conditions. When prices are higher, you buy fewer shares. When prices are lower, you buy more shares. Over time, this approach reduces emotional decisions and builds discipline. Beginners often believe investing requires perfect timing. It does not. It requires consistency. Now let's talk about risk in a practical way. Markets can react strongly to unexpected policy announcements. That can cause temporary drops or rallies. If you panic and sell during a decline, you lock in losses. If you chase fast gains without research, you increase risk. Money Monkey prefers a calmer strategy, diversified ETFs, regular contributions, reinvesting dividends, long holding periods, minimal trading, and low costs. Simple, clear, repeatable, and sometimes boring, but boring compounds. Let's make this concrete. Imagine you invest $1,000 per month into a diversified ETF portfolio. That equals $12,000 per year. Over 25 years, you would contribute $300,000 in total. Now assume a long-term average annual return of around 7%, compounded. While actual returns vary from year to year, compounding over decades can significantly increase total portfolio value compared to contributions alone. The exact outcome depends on market performance and fees, but the key driver is time and consistency. This is not about a presidency. This is about mathematics. Compound growth works under any administration because it is powered by reinvestment and long-term market participation, not politics. Money Monkey likes politics the same way he likes thunderstorms. Interesting, but not something to trade on. If you want to build wealth during any presidency, focus on what you can control. You cannot control elections. You cannot control policy decisions. You cannot control market reactions. But you can control how much you invest, how diversified you are, how long you stay invested, and how you react to volatility. For most beginners around 40 and older, a long-term approach usually means building a diversified ETF foundation, contributing regularly, keeping costs low, and staying invested for decades. Wealth is not built by predicting political outcomes. It is built by owning productive assets over time. And remember, even if markets move up or down in the short term, disciplined investors historically benefit from patience and compounding. Money Monkey does not need to be the smartest monkey in the jungle. He just needs to be consistent. So here is the takeaway. A presidency may influence markets in the short term, but long-term wealth is driven by diversification, earnings growth, reinvestment, and time in the market. Do not invest based on fear. Do not invest based on excitement. Invest based on strategy. If you found this helpful, subscribe to Money Monkey for more simple investing lessons. Because whether it is 2026 or any other year, the formula does not change. Invest regularly. Stay diversified. Think long-term. And let compounding do the heavy lifting. Monkey Money Bag.